Here's something that might surprise you. Some of the wealthiest retirees I know still have mortgages, and they're not keeping them because they have to. They're keeping them because it's actually making them wealthier. So today we're covering the financial analysis that many people overlook when they're deciding whether or not they want to pay off their mortgage before retirement. By the end, you're going to understand why the conventional debt-free retirement advice might not be the optimal for your situation if you have substantial assets and a low-rate mortgage. My name is Patrick Shope, and I'm the founder of Shope & Associates. For over 20 years, we've helped families navigate retirement planning, and this mortgage question comes up constantly. Now, let's be honest about why many people recommend paying it off. There's something deeply satisfying about owning your home free and clear. In fact, Dave Ramsey built an empire on this philosophy. Eliminate all debt, sleep better at night, and reduce your fixed expenses in retirement. And emotionally, that makes complete sense. There's comfort knowing you'll never lose your home to a missed mortgage payment. But here's what that advice misses for people with significant assets: the opportunity cost. And this is where the math gets really interesting. So let's walk through a scenario. Imagine you're 60 years old with $200,000 left on your mortgage at 3% interest. This is a rate you locked in back in 2021. Sound familiar? You've got a solid investment base and you're asking yourself, should I write that check and pay this thing off? Here's the calculation that many people never do. If you keep that $200,000 invested and it earned more than the 3% mortgage rate, and keep in mind, historically, diversified portfolios have averaged around 7% annually, according to Vanguard research on balanced portfolios. Also, though, keep in mind that past performance doesn't necessarily guarantee these future results. You see, in 10 years, you would have approximately $394,000. Meanwhile, your 3% mortgage is costing you roughly $53,000 in interest over that same period of time. This can vary depending on the length of your loan and your amortization schedule, though. In this scenario, that $200,000 could potentially grow to $394,000, approximately $194,000 in investment gains, almost double. Meanwhile, let's say that you're paying $53,000 in mortgage interest over those 10 years from your regular cash flow. What's the net result? You could be about $141,000 wealthier by keeping the mortgage and investing that lump sum. Here's the kicker. You're paying that interest with inflated dollars, while your investments can grow tax-deferred in retirement accounts. But wait, it gets even better. That 3% mortgage rate, it's fixed, which means you're paying it back with inflated dollars. If we see 3% inflation annually, and we've certainly seen higher, every year your mortgage payment effectively costs you less in real purchasing power. You're essentially getting paid to borrow money over time. So here's what surprises many people when they see these numbers. Keeping a $200,000 mortgage at 3% while investing that money can potentially leave you with $125,000 to $150,000 wealthier over a decade, even after paying all the interest, assuming the market performs as it historically has. The conventional wisdom says being debt-free makes you wealthier. But when you have substantial assets and a low-rate debt, the math can say the opposite. Now, some of you might be thinking, Patrick, that sounds great on paper, but what if I need that money? And that brings us to the second major factor, liquidity. When you pay off your mortgage, that $200,000 becomes trapped inside your home's equity. Sure, your net worth looks the same on paper, but try accessing it quickly. You'll need a home equity line of credit, which means an application, approvals, and fees, or you have to explore some other complicated options. Compare that to having $200,000 in your investment account. Need $50,000 for your medical expense? You can access it in days, not months. Want to help your grandchild with college? Transfer's done. Market opportunity presents itself. You got dry powder ready to deploy. The liquidity factor becomes even more critical as you age. Healthcare costs, long-term care costs, family emergencies. These things don't wait for your home equity loans to process. This is exactly the kind of analysis worth walking through with your financial advisor. They can run your specific numbers and help you weigh these trade-offs. But let's be balanced about this here. There's absolutely situations where paying off your mortgage makes perfect sense. If your mortgage rate is above 6%, the math starts to flip. If you're losing sleep over the payment and it's affecting your quality of life, emotional peace might outweigh potential financial gain. If you have health concerns and you want to simplify your estate for your children, eliminating the mortgage could make total sense. Also, if you don't have other investments generating returns, or if you're extremely conservative and keeping money in low-yield savings accounts, then paying off your mortgage might be your option for a guaranteed return. A great way to consider approaching this instead of the all-or-nothing approach is something that's more strategic middle ground. And this is where some professional consultation could be important. You could discuss keeping the mortgage, but consider making one extra payment per year using cash flow, not your lump sums. This shortens the loan term while preserving your liquidity and investment growth potential. Your financial advisor and maybe a mortgage provider could help you understand what options you have to calculate the impact of an additional payment. Or another option is to plan strategically, keeping the mortgage through your higher spending early retirement years, maybe age 60 to 75, when you might want to maximize flexibility for travel and activities. Then you might want to consider paying it off at age 75, when your lifestyle might start to simplify and you'll be less likely to need large chunks of accessible capital. What is truly right for your situation requires careful consideration. So let me share a hypothetical scenario that illustrates this. Let's consider a couple. Let's call them John and Mary. They're both age 62. They have $1.2 million in retirement assets and about $180,000 left on a 3.25% mortgage with about $1,100 monthly payment. So as you can see, they have an interest rate well below the 6% threshold I mentioned before, which means there may be an opportunity for them to put their money to work a little bit more efficiently. When we modeled both scenarios over their retirement, the numbers told an interesting story. By keeping the mortgage and leaving that $180,000 invested in their portfolio, again, assuming returns similar to the historical market averages we discussed earlier, they're projected to have over $200,000 more in total wealth by the age of 85 in this scenario. If they had paid off the mortgage instead, they'd have eliminated that $1,100 monthly payment and simplified their financial obligations, though with less projected total wealth in this scenario. Of course, every situation is going to be unique. Suppose at age 67, John needed unexpected back surgery, and his insurance only covered part of it. Because he'd kept his investments liquid, instead of locking that money into the home equity, he could transfer the funds within 48 hours. No loan applications, no long approval waits, and far less stress while dealing with the health crisis. The real question here isn't, should I pay off my mortgage? The real question is, what's the best use of my available capital for my financial flexibility and long-term goals? For many affluent retirees with low-rate mortgages and solid investment portfolio, keeping that mortgage can be mathematically superior choice depending on their circumstances. Also, you got to keep in mind, we're talking about people with substantial assets here. If paying off your mortgage would drain your emergency funds or prevent you from having adequate investment reserves, that changes the equation entirely. If you want to see where you're standing financially, we have a planning tool we provide for free. It takes just a few figures from you and gives you some general projections that can help you start to consider your own situation. You'll find that link in the description below. The bottom line is this. For people with significant assets and low-rate mortgages locked in during the past 15 years or so, keeping that debt may be mathematically superior and strategically smarter. You can maintain liquidity, preserve growth potential, and hedge against inflation, all while that low-interest money works in your favor. If you're facing this decision right now, don't rely solely on conventional wisdom. Run the actual numbers for your situation. Consider your complete financial picture, your risk tolerance, and your need for flexibility. This requires thought and care and sometimes some guidance. For people who have done a good job of building assets and have a low-rate mortgage, your goal may be to have more flexibility and wealth rather than just to be debt-free. Keeping that strategic debt may help you get there faster than paying it off ever could. Until next Thursday, I'll see you in the next video.